It's electric.
Dollar cost averaging is buying an asset on a set schedule over a period of time, regardless of market conditions. This works wonderfully for mutual funds and ETFs and can be considered very dangerous for individual stocks. Now, if you happen to be set up with an employee stock purchase plan, that's different. There's usually a little incentive tied there. You're working for the company you're investing in. That's a great opportunity. I would certainly take advantage of that opportunity. I would go all the way up to 25% of my disposable income. But so back to individual stocks from a retail investing perspective, the way mutual funds and ETFs behave compared to a stock in the long run is an opposite mentality. So with a individual stock, the whole thing is designed to go up. There is usually a progressively increasing dividend. There's hopefully a progressively increasing stock price. Everyone's very happy when everything's working like it's supposed to. It's all to increase the value to shareholders. Well, when it goes down, it can be madness, and it can happen very quick. There is shifts in leadership. There's executives who are replaced. It can be acquired, bought and sold, delisted. Anything can happen. People want results. Investors want blood. It's very alarming and can be short-sighted. Whereas a mutual fund or an ETF is a basket of underlying assets behaving as a single asset. So while these bad companies may fall off, they're being replaced by new companies. And this asset, the single asset that you've been buying this whole time, it maintains itself. So maybe it has a bad year, maybe it goes down in value for 10 years straight or 20 years, but it's always going to be there. It's always going to be changing the underlying investments, and eventually will come back up again. It has a very cyclical behavior. So if you look at a stock chart of an individual stock, it may appear cyclical, going up and down, but there's much more sensitive attitudes at stake. Whereas a mutual fund or ETF is going to go up and down, and people are very comfortable with that. There's definitely a lot of security in that. That is why our pension system is being replaced with 401ks. It's that secure. So buy with confidence.
So I've randomly selected mutual funds, large and popular mutual funds from various sectors. There's a S&P 500 index fund, a large cap fund, a small cap fund, a Europe fund, Asia small, gold, and global real estate. And if we compare these to each other and look at it from 5 years out, so if we look at the chart, you can see the best investments would be the large cap and the S&P 500. But if we scroll this back, you can see it change over time, and how just a couple years ago the best investments would have been the small Asia and real estate. And if we keep scrolling back, you'll see it continue to change. So as one goes down, another one goes up. There's the recession. The thing to own then would be gold. And if we keep scrolling back, now you see Europe. And then here you see a lot of gold.
So as we saw with the mutual funds going up and down at different times, you can see how there might be some value in buying the sectors that are more out of favor. Whereas a individual stock is directly reflective of the leadership and the business climate, and buying something out of favor there could be a disaster. So the way dollar cost averaging works for you is by using a fixed amount of money. You're getting a variable amount of shares. So when the price is better, you're actually getting more shares, and when the price is worse, you're buying less shares. So that really benefits the long-term investor. So when a stock's going down, it's scary, bad, and dangerous. And when a mutual fund's going down, it presents an opportunity. So there's two things an investor can control with their investments: is the buy and the sell. Nothing else. All the ups and downs in the market are unrealized gains and losses. So a investor is able to control all those buys, control their average cost using dollar cost averaging, and they're able to really have a long-term winning position on this. If you're trying to time the market, there's a lot of risk there. You're either going to win or you're going to lose. And also, if you're thinking you're going to win, You may be using patience to do so. I hope you are. And if you are, that means you're sitting on the sideline. So you're sitting on the sideline, you're waiting for the right time, and then you do go all in, and you may be wrong. That's two reasons right there why if you were just doing dollar cost averaging with a mutual fund or an ETF, I wouldn't risk it. Stock can be a complete disaster when it's going down. So you want to be very careful in that situation. And a lot of times, the smartest guys in the room will cut their losses and walk away and start again another day. Finance guys will roll their eyes when retail investors are throwing their money after trying to improve their average costs. It's called throwing good money after bad. With an individual stock, with a mutual fund, you just keep buying. It might be 10 years, but you just keep buying. Let's do an example. All right, here we are on Yahoo Finance. I've got a S&P 500 index fund that I'm looking at. I want to look at the chart. You can see here, this is the recession that a lot of novice investors, retail investors, probably made a lot of really bad decisions. But if you had watched this video, you would know that it's just going to go up and down. So this would be an opportunity. To demonstrate that, you can download the historical data. I wanted 20 years, but it actually only starts in 1997. All right, so here's our data. So we're going to begin by purchasing $10 of the fund every week. So the first week we would contribute $10 to the fund of the S&P 500 index fund, and that would give us this fraction of a share. Our average cost per share, we're going to calculate as total cost divided by total shares. Add anchors so that I can drag this down. And we're going to calculate our unrealized gains. So the next week, we'll contribute $10. The closing prices went up 3 cents. I'm going to delete some columns here. We don't need all this noise. We actually only need one price. It's a mutual fund. It's the prices are adjusted after trading hours. So the cost went up 3 cents, which means because we had bought it at a better price the week before, our unrealized gains increased by a fraction of a percent. Now if I drag this down for 20 years, we know the recession's in there. So I'm going to do an Excel function for minimum, find the minimum number, just to see how bad things got. And there we have 57% of our invested amount of capital this week, March of 2009. So at this point, you've lost almost half of your entire investment. So the worst reaction, obviously you'd be really upset you lost almost half of your investment. The worst reaction would be to dump the fund in frustration. You would realize that loss. The other bad reaction would be to wait for the trend to reverse and begin buying when it's going up in value. That really, that's like timing the market. You're sitting on the sideline and you're waiting, and it's more lucky than good. I think it's impossible to time a market. So the way to do it would be to continue to stay the course. That's dollar cost averaging. With each week that goes by, you're actually improving your cost. And sure enough, the market, as you can see with the share price jumping here, it does reverse relatively quickly. And you would be back in the black here in January 2010, so not even 1 year later. So all of that panic and bedlam regarding the Great Recession, the greatest recession this country has ever had, would have rebounded. Your entire investment rebounds in less than a year. You can see over the long term how dollar cost averaging can really help your position and can be used, it can eliminate the risk of market timing with regards to a mutual fund or ETF. but with regards to using dollar cost averaging to improve your position with a individual stock, it can be very foolish.